Okay, I want you to picture this. You're sitting at a massive, polished boardroom table. Slid right across that table is a very real, very serious offer for your struggling tech company. It's an all-cash and stock deal worth a mind-bending $44.6 billion. We're talking a massive, ridiculous premium over what the open market says your company is actually worth. It is literally the ultimate golden parachute. It's the dream exit strategy every single founder on Earth prays for. All you have to do to make your shareholders unimaginably rich is say yes. But you don't. You look at that life-changing pile of money and you say no. You dig your heels in. You say it's not enough. So what happens when a founder's ego completely blinds them to the brutal reality of the free market? Well, you're about to find out. Welcome to This Explainer. Today, we are taking a deep dive into what is arguably one of the most spectacular strategic failures and catastrophic financial blunders in the history of corporate business. We're looking at a high-stakes, multi-billion-dollar staring contest that went so incredibly wrong, it's actually hard to believe. By the end of this, I'm going to reveal the shocking final fate of this mystery company and exactly how much that one single arrogant no ended up costing their shareholders. Trust me, the sheer scale of the wealth destruction here is wild. Let's get into it.
Section 1. A mysterious mega offer. Winter 2008.
To really grasp the sheer scale of this blunder, we kind of have to set the stage and look back at the rapidly shifting internet landscape of 2008. At this point, web search and online advertising were quickly becoming the absolute most lucrative real estate on the planet, and a massive winner-takes-all war was brewing. Just look at this breakdown. Google was sitting in an absolute, unquestioned 65% dominance in the search market. They were a juggernaut. Way down at the bottom, Microsoft, sitting in a measly 8.4%. Microsoft was literally watching Google eat their lunch and capture unimaginable ad revenues. They were desperate. They needed a weapon, fast. And that weapon? It was the company sitting right in the middle at 19.6% market share, Yahoo. Microsoft basically figured, hey, if we combine our endless cash with Yahoo's billion users and established web presence, we might actually create a credible threat to Google. So, on February 1st, 2008, Microsoft CEO Steve Ballmer makes his move. He approaches Yahoo co-founder and CEO Jerry Yang with a massive opening bid, $31 per share. Now, why does that specific number matter? Because that $31 represented a staggering 62% premium above Yahoo's closing stock price at the time. A 62% bonus, essentially, on a stock that was struggling. Yahoo had been issuing profit warnings, laying off thousands of employees, and facing some really fierce headwinds. Microsoft was basically throwing them a life preserver made of solid gold, valuing the whole company at roughly $44.6 billion. I mean, this was the biggest proposed internet deal since the disastrous AOL-Time Warner merger.
But here is exactly where the story takes a hard left turn into sheer financial madness. 10 days later, Yahoo CEO Jerry Yang and his board flat out reject the payday. No negotiation, just no. They arrogantly claimed the offer was, quote, substantially undervaluing the company. Look, Yang had watched his baby, Yahoo, grow to a $125 billion valuation back during the crazy days of the dot-com bubble. He was completely anchored to the past. He honestly believed Yahoo could engineer this magical turnaround entirely on its own. The board demanded something closer to $40 a share, a price that would have valued the deal at an insane $56 billion. It was a massive, high-wire gamble, betting the entire house on a turnaround that literally no one else in the broader market actually believed was possible.
Section 2. The ultimate staring contest.
At this point, this wasn't just a standard business negotiation anymore. It had mutated into a bitter, high-stakes standoff between two incredibly stubborn tech titans. Microsoft couldn't afford to lose the search war, and Yahoo's founder just couldn't bear to let go of his baby. Let's walk through this timeline, because it happens fast. After that initial February rejection, Microsoft didn't just pack up and go home. In April, Ballmer comes back to the table. He sweetens the deal to $33 a share, pushing the total offer up to roughly $47.5 billion. But this time he brought a stick, a 3-week ultimatum: accept the offer or face a hostile takeover, where Microsoft would just bypass the board and go directly to the shareholders. But Yahoo? They stalled. They refused to make a serious counteroffer. Finally, after an incredibly tense weekend meeting in early May, the staring contest broke. Microsoft had enough. They completely walked away.
Now, the real reason Ballmer finally walked away wasn't just about the cash, even though Yahoo was stubbornly demanding an absurd $53 billion at that point. It was actually because of a toxic poison pill strategy Yahoo was threatening to swallow. Get this, Yahoo actually explored outsourcing its own search advertising business to its sworn enemy, Google. Yeah, By threatening to partner with the absolute dominant market leader, Yahoo would have essentially dismantled its own core search engine just to fend off Microsoft. Microsoft realized immediately that this would create a massive regulatory and antitrust nightmare that they absolutely did not want to inherit, and it would completely destroy Yahoo's long-term value anyway. It was basically financial suicide disguised as a defense mechanism.
The official withdrawal letter from Steve Ballmer on May 3, 2008 is just an absolute masterclass in corporate coldness. Ballmer, who is known for his legendary intensity, sent this polite but utterly brutal warning. He wrote, "By failing to reach an agreement with us, you and your stockholders have left significant value on the table. That is CEO speak for, you just made the biggest mistake of your lives." Microsoft was literally the only buyer in the world willing to pay a premium for Yahoo. Yahoo had zero leverage, zero alternative buyers, and Ballmer knew it. The lifeboats were officially gone.
Section 3. The Shareholder Revolt and Humiliating Decline.
The very second Microsoft walked away, gravity took hold, because Wall Street, unlike Jerry Yang, is incredibly dispassionate about nostalgia. The market reaction was brutal, and it was instantaneous. On May 5th, literally the very first trading day after Microsoft officially withdrew its bid, Yahoo stock plummeted by 15% in a single day. $6 billion in shareholder value, poof, wiped out, vaporized into thin air. The stock dropped from over $28 right back down to $23. This is exactly what happens when a board overplays a very weak hand and gets called on it.
And the chaos that followed, legendary. Furious institutional investors immediately filed lawsuits against Yahoo's board, claiming they completely failed their fiduciary duties. And then there was blood in the water, and a shark appeared. Infamous activist investor Carl Icahn bought up 59 million shares of Yahoo. That's a massive billion-dollar stake, and he launched a brutal proxy war. He went on the offensive, publicly calling the board irrational, and he explicitly threatened to replace all 10 directors just to try and force the Microsoft deal through. The internal bleeding at Yahoo was completely out of control at this point.
What followed was just a humiliating, agonizing decade of decline. It was a chaotic revolving door of CEOs that turned this once great internet pioneer into a literal Silicon Valley running joke. Jerry Yang, facing that massive shareholder revolt, was forced to step down just months later in November 2008. Then came Carol Bartz. She was infamously fired over the phone in 2011. Yikes. Then Scott Thompson took over, but he had to resign in 2012 amid a crazy resume padding scandal. Then an interim CEO stepped in. And finally, they brought in Marissa Mayer from Google, but even she couldn't stop the bleeding. The fundamental truth, the one nobody wanted to admit, was that Google had already decisively won the search wars, and absolutely no amount of management shuffling could reverse that reality.
Section 4. The Data Breach Catastrophe.
All right, just when you think the story couldn't possibly get any worse for Yahoo's poor shareholders, a catastrophic hidden secret emerged from the shadows. In 2016, as Yahoo was desperately trying to sell off its remaining severely depreciated assets, a massive bombshell dropped. They disclosed that back in 2014, a massive data breach had compromised 500 million user accounts. Names, emails, passwords, all stolen. But the real scandal here? It wasn't just the hack itself. It was the cover-up. Shareholder lawsuits quickly alleged that Yahoo's board and senior executives actually knew about this catastrophic breach, but actively concealed it from investors and potential buyers just to protect the company's incredibly fragile valuation. And then came the terrifying escalation, because it gets worse. Just months after that first announcement, another hidden breach came to light. This one was from 2013, and the number of affected accounts wasn't just in the millions, it was 3 billion. Let that sink in. 3 billion. Every single Yahoo account in existence at the time had been compromised. This revealed years of gross corporate negligence. 6 U.S. senators demanded immediate answers, the SEC launched heavy investigations, and Yahoo found itself suddenly buried under an absolute avalanche of class action lawsuits. Section 5. The Final Reckoning. So, Yahoo's years of arrogance, their stubborn refusal to sell at a massive premium, and their actively hidden cybersecurity failures were all finally about to catch up to them at the negotiating table. But actually, before we hit the final depressing numbers, we do have to acknowledge the one single thing Jerry Yang did absolutely right, because it actually makes this whole story even crazier. Back in 2005, Yang orchestrated a brilliant $1 billion investment for a 40% stake in this then unknown Chinese e-commerce company called Alibaba. Well, when Alibaba eventually went public, that stake became worth tens of billions of dollars.
And ironically, this phenomenal stroke of genius success makes Yang's rejection of Microsoft's $47.5 billion cash offer even more baffling in hindsight. Why? Because the core Yahoo internet business was dying. It was entirely being propped up on the balance sheet by the massive value of that Alibaba stock.
And now we reach the ultimate, jaw-dropping contrast, the true undeniable cost of a failed strategy. On one side of the scale, we have Microsoft's sweetened 2008 offer of roughly $47.5 billion in cold hard cash and stock. On the other side, we have the mysterious final price that the telecom giant Verizon actually paid for Yahoo's core internet business in 2017. This is after the proxy wars, after the revolving door of CEOs, and after the catastrophic data breaches. Let's see the damage.
The final price was a measly $4.48 billion. You heard that right. Verizon bought the absolute core of an internet pioneer for absolute pennies on the dollar. And keep in mind, because of the massive data breaches we just talked about, Verizon actually forced Yahoo back to the table and slashed an additional $350 million off their already depressed asking price right before the deal closed. Talk about adding insult to injury.
I really want you to focus on this staggering number right here, $43 billion. That is the sheer scale of the financial tragedy we are talking about. That is the massive gaping difference between what Yahoo was offered on a silver platter in 2008 and what its core business finally scraped together a decade later. $43 billion in value, completely and totally evaporated. Why? Because a board couldn't admit that their company's absolute best days were behind them, and because they let their egos completely override a dispassionate, rational analysis of the market.
And honestly, the pain didn't even stop at the sale price. The legal fallout from this whole mess was entirely unprecedented. Beyond that $350 million price reduction Verizon forced on them, the sad remnants of Yahoo were hit with a $117.5 million consumer class action settlement. The SEC slapped them with a $35 million fine for actively hiding the breaches from investors. And perhaps most shockingly, the former directors and officers actually agreed to pay $29 million out of pocket to settle a breach of fiduciary duty lawsuit. Let me be clear. That was the first ever monetary settlement by a company specifically for a board's failure to disclose cybersecurity breaches. It sent absolute shockwaves through corporate boardrooms everywhere. You can't just hide this stuff.
Which really brings us to our final provocative thought for today. Did founder worship and plain old ego destroy the greatest exit opportunity in internet history? Today, the Yahoo-Microsoft staring contest is literally taught in business schools. It's the ultimate cautionary tale of exactly what happens when emotional attachment overrides dispassionate market analysis. Look, the technology sector allows absolutely zero second chances. Markets move lightning fast, competitive advantages erode overnight, and when a $47 billion lifeboat arrives during a storm, you don't stand there arguing about the color of the paint. You get in. Thank you so much for joining me for this explainer. It's a wild story, right? I'll see you in the next one.